Hello friends, last week the rally that you saw in the market can only be termed as a crackerjack rally. Now the foremost question in everybody's mind is this rally going to sustain? Have we missed the bullish bus and is it too late to buy now? This video is all about helping you decide whether fear of missing out is likely to take the markets higher and if it's too late to buy. If you remember, since the last 3 weeks, I've been giving you statistical evidence in my weekly videos as to how the markets seem to be bottoming out, the bears are on a back foot, the bulls are attempting to come back, and risk-on sentiment is coming back. And that is exactly what played out. Of course, I was interspersing my advice with a lot of caution, but it was necessary because of the volatility. What happened last week is on your screen in the market roundup window. What you're seeing is that it was the Nifty, the broader based Nifty that led the rally. The Bank Nifty followed suit. So the rally was fairly broad based. And the US dollar index, the Dixie, went down against the global basket of currencies by 72 bips. And that was pretty good for emerging markets. I've told you time and again, a weak dollar is good for emerging markets. And it also boosted gold and silver prices. Crude oil also went up on a falling dollar. And natural gas fell for a change, which seemed to have given a sigh of relief to a whole lot of inflation hawks out there. The 10-year benchmark bond yields also fell 13 basis points because there was a sigh of relief after the US Federal Reserve raised rates. The markets took a lot of comfort from the forward guidance about further rate hikes coming only after the inflation data was perused. The NSE market capitalization went up by 2.13%, which tells you that the rally was fairly broad-based. Frankly, it was Wednesday, Thursday and Friday which has brought cheer to the markets. The market-wide position limits, the MWPL, fell 7.11%, but it's natural on expiry. Let's not forget Thursday was an expiry. And the US market indices have risen. That basically gave a lot of bullish impetus to the market traders here. Let's now see the US markets. Coming up on your screen is the Dow Jones Industrial Average daily chart. It managed to break out above the 31,886 levels, which I told you about. And the next hurdle on the way up is 33,272, which is a previous swing high. Do remember that the death cross, the 50-day moving average falling below the 200-day moving average, still remains in place. The index has only gone up above the 50-day moving average, but the death cross still remains. So that's not negated, which means that this rally still remains a technical pullback. Let's now see the Nasdaq 100's technology index, which has a great deal of bearing on our technology stocks in India. That's given a breakout above the previous high, which explains to you why the frontline tech counters rose on Thursday and Friday in India. The level is 12,898. Now, if the rally is to sustain, the Nasdaq 100 must remain above this threshold continuously. And here again, the death cross still remains in place, even though the price may be above its 50-day moving average. So, still a technical pullback. The broadest index of them all, the S&P 500, still to cross its previous resistance high at 4,178 levels. The death cross remains in place. Price has only managed to go above the 50-day average. So a technical pullback rally is underway here. Now coming to our domestic markets, I'm showing you the MWPL weekly chart, the market-wide position limits. This is the extent of limits utilized by traders vis-a-vis the total limits allowed by SEBI. Now this is a good to Marshmallow traders' risk appetite. And look at what has happened last week. Ahead of expiry, we saw a level of 28.59, which is the highest after March expiry. And on a Friday after expiry, the MWPL has fallen to 21.48, which is the highest in 5 months, which tells you that traders are not letting go of their positions. They are holding on to their long positions. Now this is a green flag number 1. So traders are showing signs of higher risk appetite. And have you missed the bus? Now I'm coming to that. Stock and index futures turnover on a week-on-week basis. Remember, this is a cumulative turnover of 3 consecutive expiries. So it's August, September and October. The turnover has actually fallen, which is not really a good thing to happen. Turnover should have risen, which would have told me that one Marshmallow traders, who basically are intraday traders, they roll over their positions to the next day, are showing a lower risk appetite. I now come to the basis chart of the Nifty and the Bank Nifty prompt month futures. Basis is nothing but the premium or discount enjoyed by futures to spot, and the basis has gone up because we shifted from July to August futures series. There's one full month for traders to play around with, which is why they are willing to pay a higher premium. What we want to watch out for in the coming days, my friends, is that the basis should not get inverted, which means the futures should not trade at a discount to spot. As far as the prices and bases are going up hand in hand, the bullishness is likely to sustain. So do keep watching this. This is a metric I keep updating on my social media accounts every single day in the evening, so do connect with me. I now come to the advanced decline ratio on the NSE, and on a week-on-week basis with a 20-week bias, we are seeing that this is the 6th week when the advanced decline ratio has stayed above 1. So, one Marshmallow appetite, intraday traders have continued to prevail over the bears. The bulls have managed to prevail over the bears, and the advanced decline ratio is at a 4-week high. Now that's a second green flag for the market. Now I come to the Impetus chart, which is something that you have relied upon very, very heavily for more than a year and a half now. Here, there is a sign of slight caution. The Bank Nifty Impetus has risen marginally, a tad. It's noticeable, but it's marginal, which means that the rally of last week is something that lacked a significant amount of momentum that would have been required to sustain the upthrust. The Nifty's impetus, on the other hand, has actually fallen. So that is a very small red flag. Let's not forget that the kind of volatility that the markets witnessed is something that can put off the bravest of traders. To be absolutely honest with you, I've made a very small, tiny amount of profit as compared to what we would have done in a market that moves by this magnitude, because the sudden intraday statistical beta, it means bullish to bearish, bearish to bullish, and vice versa, the flip-flop was too fast, too hard. So we need to watch A, the traded volumes, B, the basis, and C, the impetus. I now come to the LWTD, the Lift Weight Thrust Drag Index, the latest in our addition to our in-house exclusive indicators. You won't find any of these indicators, the Impetus and LWTD, anywhere on the internet domain. Now, the the Nifty 50 percentage gain or loss line indicated as a blue line is up, and it's up to a 6-week high. But the LWTD line, although has risen on a week-on-week basis, admittedly, it is still very slightly below the zero mark, which means at higher levels, there is a possibility that some profit taking might just come in. Do remember that on the 5th of August 2022, which is Friday, the RBI's Monetary Policy Committee is going to announce its decision on what India wants to do with its benchmark rates, the coupon rates, repo rates. So that kind of nervousness might just keep bullishness slightly under check, which is why the LWTD seems to be a little sluggish. Now I come to the footprint of the 4 types of market participants out here. The FIIs have basically shown a tendency to book profits on their individual stock longs and have turned into net longs from net shorts in the index futures. they've reduced their stock futures and increased their index futures longs. DIIs, on the other hand, still remain net short, but their shorts are coming down, which is a indirect way of saying that they have increased their optimism on the market. Now for prop traders, and this is very interesting. Prop traders, individual stock futures exposure had gone down to 47,599 lots, which is the lowest in many, many months. It's more than doubled to 97,523 lots. For the want of any other words, I would say the prop traders are back. These are brokers' own trades. They are second best to insider traders because they know who's buying what, how much, at what price, and therefore they are basically super sharp watchers of the market, and they're worth following. So their index net short positions have also come down very, very sharply. It remains a little over 50%, but they've cut their index shorts also aggressively. Now, for retail investors, these guys have been doing all the heavy lifting ever since the lockdowns were imposed thanks to COVID. And what we see is that they are net short in the index futures. But their individual stock futures net longs have gone up again to 1 million plus units, which had come off from a high of 13.5 million. So that's still a very big fall. What it tells me is that retail traders are not really increasing their long positions at lower levels, which raises the probability, I'm using the word probability, that at higher levels, they might just be waiting in the wings to get out of long positions which are in losses. So that kind of provides resistance on the upsides. So let's watch these figures keenly, but so far the tilt is towards the upside. Now, for the four stocks that I talk about due to their sheer weightage in the markets alone, and these stocks, four stocks, can swing the Nifty and the Bank Nifty in their direction. The heaviest weighted stock, Reliance Industries, weightage of 12.94%, beta, which is the intraday volatility, is 1.12, which means for every 1% beta in the Nifty, this stock's beta will be 1.12%. Impact cost is 0.02%, which means the buy-sell difference is very, very narrow. So it's a very cost-effective counter to trade. Now, we need Reliance Industries to cross the previous swing high of 2,542 before this stock can give a breakout. The fact that it has gained on a week-on-week basis last week has pushed the index higher. Second heaviest stock in the Nifty, HDFC Bank, with a weightage of 8.55%, lower beta than Reliance, has already broken out above the levels I talked about last week at 1410 and 1421. Now, in case of declines, these levels need to be defended. As long as these levels are defended, I think this stock will get support and go on the way up. It's the heaviest weighted counter in the Bank Nifty. So not only does this counter impact the Nifty, but the Bank Nifty as well. Now for Infosys, very, very interestingly poised near its breakout level of 1,555. It has a huge weightage of 7.73% and the most volatile counter out of these big four with a beta of 1.6. So if the Nifty is moving 1%, this will move 1.6% in either direction. Impact cost mercifully remains low. Let's wait and watch and see if 1,555 is overcome with heavy volumes and open interest expansion in the spot. Last but not the least, ICICI Bank with a weightage of 7.11%. Beta is fairly high, 1.4. Impact cost remains at 0.02. Has already indicated a breakout above the 778 previous swing high. Now, this has been overcome. On the way down, this will become a support. Bulls must defend 778 in case ICICI Bank falls. As long as all these four counters meet the criteria which I just mentioned in the last couple of minutes, you're going to see the Nifty and Bank Nifty rise higher. Friends, the studies done, I now come to the bond markets, the most critical area, and in light of the fact that the RBI is going to announce the interest rate decision on Friday, the 5th of August, it becomes even more critical to watch. Bond yields have continued to soften for the third week in a row. All right, which means bond prices are rising. There's a mark-to-market relief from losses on bond portfolios to banks, which is why Bank Nifty has been going up. Don't let anybody tell you that bond prices and bond yields don't matter. Even if you're only an equity trader, you must watch bond yields. Recently, I said I'm basically betting that 7.25% level is likely to hold. Now, that was tested last week and it held. In the coming week, I'm not so sure. If bond yields were to come down, which look like a possibility if you were to watch the US markets, there could be another move up in the banking stocks and by default, the Bank Nifty. So do keep watching this threshold. The rupee that has basically bounced back from the 80 minus levels back again to 79 quarter, 79 and a half seems to have enthused the bond markets as well. So let's watch the combination of the inflation print, the rupee and the bond yields. Now friends, I come to the US dollar index, which is a very critical area for emerging markets because a strong dollar results in imported inflation. Whatever we import, landed price goes up, so imported inflation goes up. Now, I told you that the US dollar index was ripe for a corrective decline, and here it is. The index has fallen on a week-on-week basis by 72 basis points, and it fell on 4 out of 5 trading sessions, as you can see on the daily chart on your screen. The price is below its 25-day exponential moving average, which is a proxy for a month-long holding on cost. So the short-term outlook seems to be under pressure. The weekly chart on your screen tells you that this was the second consecutive bearish candle, and the price remains far above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook still remains positive, but the fact that the price is far above its moving average tells you that there's scope for downward movement. Now, if the US dollar index was to fall, emerging markets, including India, will possibly move higher. Now, last week I advocated a range between 108.35 on the upside and 104.75 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I expect a range between 107.65 on the upside and 104.05 on the downside. Friends, the dollar index done, I now come to the Nifty 50, which has gained on 2.05% after recording gains on 3 out of 5 trading sessions. Wednesday, Thursday and Friday were spectacular and noticeable. What you are seeing on the daily chart on your screen is, number one, you've seen a breakout above the previous swing high, which I talked about last week at 36,084 levels. A breakout above a downward sloping trend line, which was made in the 3rd week of October 2021. And the price is remaining comfortably but aggressively above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. What do we need for the Bank Nifty to sustain the momentum? Number one, it needs to stay above the 36,084 levels. And the momentum will continue as a higher tops and higher bottoms chart formation. But if at all there is a severe correction for whatever reason, overseas or the RBI, the bulls will need to defend the 35,543 odd levels, which is the previous swing high, fairly proactively. That will sow the seeds for the next round of an upthrust. Now, provided the momentum continues upwards, I think the previous swing high at 38,759 marked in blue text will be your immediate target objective for the Bank Nifty. Coming now to the weekly chart, we are seeing that the price has broken out above the downward sloping trend line, and the 25-week exponential moving average, which is a proxy for a 6-month holding on cost of a bull, has also turned upwards. Now, this is a fairly noticeable green flag. We need the momentum to sustain, we need the average to turn higher and the price to remain higher above the average continuously if the rally is to have legs. What we have seen is that the 38,759 previous high was made on a inverted hammer. That means there was a lot of tug of war around that level. There will be higher volatility as the Bank Nifty approaches this level, so you need to be extra cautious out there. In the week before last, this index was number 4 on our in-house beta list, the volatility list. It fell by 1 notch to number 5, which is a good thing. And it's not because the Bank Nifty's volatility eased off, but individual stock volatility rose faster than the Bank Nifty too. We want volatility to come down so that the retail trader does not encounter too much of a challenge. Previous week, I advocated levels between 38,375 on the upside and 35,100 on the downside, which held perfectly well. In the coming week, I advocate a range between 39,125 on the upside and 35,875 on the downside. Continue to trade light and keep your stop losses diligently. Do remember the RBI is announcing interest rate decision on the 5th of August. Friends, the Bank Nifty done. I now come to the Nifty 50, the most liquid and highly traded low impact cost derivative instrument on the NSE derivative segment. This index gained 2.62%, rose on 3 out of 5 trading sessions last week. Starting Wednesday, it started its magic, surprised a lot of people. The daily chart on your screen tells you how many gaps it has left. Gap on Thursday, gap on Friday, and that tells you that there was a lot of enthusiasm in buying momentum. Price has moved significantly above its 25-day exponential moving average, which is a month-long holding on cost of a bull. So the outlook remains positive, but mean reversion or a pull lower from the moving average can also result. Which is why I told you that the impetus chart showed that the Nifty was not gaining impetus like the Bank Nifty did. That's a very small, tiny red flag as far as I'm concerned. Last week, I told you that we need to break above the 16,794 levels, which is a previous swing high. We've done that already. The 17,694 level will become a support on the downside. A violated or an overcome resistance becomes support on the downside. So bulls must defend this level anyhow. As long as the Nifty does not fall below this level, possibility is of gaining another 400, 500, 600 points in the coming week. No matter what happens, the 16,275 level cannot be violated. This is a support area which I gave you last week, never tested even though the Nifty came down on Monday and Tuesday, so the rally remained intact. I kept communicating with you on our Telegram channel. Please take the effort to connect with me there and follow all the leads that I give you about the market. Let's now go to the weekly chart, which shows the second consecutive powerful bullish candle out here. The price is above its 25-week exponential moving average. That's a 6-month holding on cost of a bull, which tells you that the medium-term outlook is now turning positive. The fact that the average itself is turning upwards tells me that there's optimism in the undertone. But early days yet, we need to sustain this. We need to go above the 17,400, 17,500 levels to rope in the disbelievers, the skeptics, and imbibe a big kind of a short covering based rally. Will it happen? We'll continue watching every week, every day, and I'll keep posting stuff on my social media accounts. In the week before last, this index was number 7 on our volatility list in-house, and last week it fell 4 notches to number 11. That tells you that individual stock volatility rose and the Nifty volatility remained constant. So the volatility came down in overall rankings, which is good. A retail trader needs lower volatility, otherwise it puts him off. Last week, I advocated a range between 17,325 on the upside and 16,100 on the downside. which held perfectly well in spite of all that up and down and gaps. In the coming week, I expect a range between 17,775 on the upside and 16,525 on the downside. Do trade light, keep stop losses. Do remember, it's a very data heavy week, the big trigger being the RBI's interest rate decision. Now friends, the latest study that I've added, the risk appetite of the retail traders by watching their turnover footprint in options versus futures. What I am seeing is that options turnover remains robust, but futures turnover, which is shown as an olive green line, is down on a week-on-week basis. In spite of the fact that it's an expiry week, there's dual turnover. One, you square up the July series. B, you enter into the August series. That should have seen higher turnover. In spite of that, the turnover is lower. Do remember, Nifty's impetus is giving you a slight warning. So risk appetite seems to have gone down a little in terms of footprint, in terms of exposure in the retail space. We want this metric to rise with the price so that risk is back. Now friends, what if you are a long-term investor? What would you do? Would you fear missing out on the rally? Look, if you're a 5 or 8 or 10 year tenure investor, a 5 or 10% move in the stock price or the index is nothing but a blip on your long-term radar. I know it's substantial, but for a very, very long-term, decade or plus tenure investor, that's a blip on the radar. I don't think you should worry. What if you're a day trader? I feel you should be very cautious because the impetus has not really risen as much as I would have wanted it to. The LWTD is still minus by 0.02. And do remember that the risk appetite, as the option future chart, volume chart also is telling us, that there is a little bit of caution. And it's a very data heavy week. We don't know what the RBI is going to do. So let's be careful out there. And what if you're a short seller? Hey, be very, very careful out there. In case you want to go short at the upper end of the ATR on an intraday basis and no less. Don't try to preempt the market. Don't try to second guess the market and try to be one step ahead. Possibly the volatility will kill you. So I've covered all three aspects: long-term investor, short-term trader, and a specific bear. Friends, I now come to the most popular segment of this video, wherein I give you 5 stocks that have gained the most amount of impetus on a day-on-day basis and 5 stocks that have lost the most amount of impetus on a day-on-day basis. Gainers, take small exposure, wait for large price moves. Losers, impetus losers, take a bigger exposure and wait for smaller price move to scalp. Direction will be decided by your snapcode window. So, impetus gainers list is led by Honeywell Automation, second Bajaj Finserv, number 3 Bajaj Finance, number 4 Shree Cements, number 5 Naveen Fluorine. Impetus losers list is led by Idea, number 2 PNB, number 3 Indian Oil Corporation, number 4 IDFC First Bank, and number 5 NTPC. Friends, this hierarchy changes day to day, and which is why I have suggested this list only on Monday. Should you want to be updated Tuesday through Friday, please join our Telegram channel. The link is in the comment below and in the description below this video. And also choose if you want to be included in our free broadcast list. Contact details in the description and at the fag end on this video. Friends, before I bid goodbye to you, a reminder to click like on this video. If you liked what you saw, subscribe to my YouTube channel if you haven't already done so. Good, bad or ugly, let me know what you think about our work here and help us reach out to like-minded smart investors like yourself by referring my video to your family, friends and all social media groups. Thank you for your patience in being with me till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye.